Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Jay Das joins us today from Palo Alto, California. Jay is a co-founder, partner, and president at Sapphire Ventures, where he focuses on growth stage investing across enterprise software and blockchain technologies. Jay has a prolific track record with 14 investments that have IPO'd, including Box, Five9, and JFrog, to name a few. Prior to co-founding Sapphire, Jay began his career as a developer and eventually moved to Intel Capital, where he began his investing career. Jay, welcome to the show.
Thanks for having me, Nate.
You bet. Can you walk us through your background and give us your path to venture?
Yeah. Although I've been in venture for almost 2 decades now, I kind of think of myself as a VC by chance. That was not a career that I wanted to take. So I grew up in India, came to the US from undergrad. I ended up joining after graduation, went to Oracle to be a developer. And during the dot-com boom, so, I had a little company that I sold off and went to business school. And, out of business school, I kind of thought that I would come out and start another company. And that was the reason I went there. I just wanted to take 2 years and learn some more about economics, mostly about behavioral economics, right? But while I was at Booth, I ended up actually doing due diligence for a small brokerage and kind of a venture shop called First Analysis. And they're still around. And that's where I kind of got interested in investing in startups and seeing how startups kind of develop and build. And, it was for somebody coming out of Booth at that time, this is like 1999, it used to be hard to get a job in venture, right? It was still not a kind of industry where it's right now. It was much more boutique-y, and you had to know people to get into venture. And I was lucky enough to join Intel Capital. And I was at Intel Capital for the first 2 years and really spent my time actually learning how to be an investor in some ways at Intel's dime, because I invested during the dot-com bubble where, things where I would invest and, in like 6 months later, it was like a $5 billion, $6 billion public company. And you thought that things would be very easy. And just like a lot of people are probably going through now who started investing the last 2 or 3 years, every time you invested, you thought, you saw the next round would be an up round and, they would raise money in like 2-3 times a year. And, you would go off and be a public company. But that all changed, after the bust happened. And that's why I probably learned the most about being a VC during the first dot-com bust, where, I had to go in and try to merge companies. I actually had the pleasure of actually shutting down a company where you had to pay off all the liabilities like, vacations and unpaid salaries and things like that, and, sell off the assets to an IP firm, things like that. Those were the days, and when you realize that, you look back and you see a lot of people's dreams were kind of, washed away, right? But the industry recovered, right? I remember people saying that venture was dead, nothing could happen. And then it went on and, went through the whole boom. And, it took about 4 or 5 years to recover. And then we had another downturn in like 2007, 2008. And at that time, I had actually joined SAP Ventures, which was at that time a corporate arm of SAP, along with my co-founder, Nino. And we had joined there to kind of spin off the company and make it a platform. And we did that in 2011 after 4 years at SAP and, started with like 350 million in AUM. And that was our first fund. And we were lucky enough to have a lot of investments that ended up doing really well. Like we were in LinkedIn, we were in ExactTarget, Fitbit, we were in, Alteryx, MuleSoft, all of these were in Fund 1. And after that, we ended up raising another, 10 billion or so over the next 10 years, with the latest fund being a $1.8 billion fund. So that has been the journey. And, along the way, it has never been the goal to be like, okay, I want to be an investor. I think it has always been my goal to be kind of along with the founder, help companies and entrepreneurs kind of build and scale and become companies of consequence. Mm-hmm. And for me, the fun part and why I still keep doing this is the whole product development and working with the entrepreneurs, right? Figuring out the product, figuring out the go-to-market strategy. Those are the fun and challenging stuff that never gets boring. And that is what you focus on instead of, and the returns. I think when we started, we never thought that our firm would be as successful as it is now, right? I still remember when we raised our first $1 billion fund, we were like, wow, we didn't think we could get there, right? And now we have ambitions to raise, larger funds and, deploy more capital and be a global fund.
Yeah. Well, congrats on all the success. I mean, for any of those in the ecosystem, they know the name Sapphire very well. And you touched on this a little bit, but in your own words, if you could describe the thesis that you guys have at Sapphire, that'd be great.
Yeah. So, when we started out, we thought that we would be a generalist fund, right? And quickly we realized that, we have to be specialized to be successful. When you are a generalized fund, one of the things that you run up against is how do you help your portfolio companies, right? So we invested in consumer companies, we invested in consumer companies in India and fintech companies in India. But what we realized was that helping those companies grow and scale is extremely hard. One, you don't always know the domain and you also cannot provide a lot of services that can help these companies grow and scale. So we, maybe 7-8 years ago, decided to focus solely on enterprise B2B software, right? And even there, we decided that, look, we are much better at helping companies scale and grow once they have had product market fit. So focus on, late Series Bs and Series Cs and beyond, where companies had at least 10 to 12 million in ARR and, they have a repeatable sales motion where we can come in and give them capital to scale and, also help them with a lot of the services that we have, like our CXO network, which helps customers, talent network, for board members and management team members, an operating partner that can help people scale. And so that has been the focus now. So it's 3 geographies we focus on: US, Europe, and Israel. And, anything in enterprise software, all the way from infrastructure all the to applications.
You're one of the few recent guests that has seen multiple downturns. You talked about how you started investing around the .com bubble. And I believe this is the 3rd time you've navigated your companies through a downturn. What is your biggest piece of advice for founders on how to navigate these turbulent times?
Yeah. So first and foremost, I think number one, everybody keeps talking about that, hey, cash is king. If you don't have cash, if you're not able to meet payroll, you're not going to have a company. So that is the number one thing, is that when you are going through a downturn, preserving cash is going to be number one, right? And people are doing that. I think the second thing that you have to also realize is that, in this downturn and trying to get the cash, valuation doesn't really matter, right? If you're valued at, say, $1 billion, but, it's worthless, it doesn't really matter, even if you own like 10, 20%. So a lot of entrepreneurs get caught up in the ownership game where they're saying, okay, I own 10% of some company. Now, if I get, new investor coming and they'd give me a down round, I'm going to get 8%. And, my answer to them is that, look, 8% of something is more than 10% of zero, right? Mm-hmm. So I think that is the other thing that entrepreneurs have to remember is that, down rounds can be bad, but I've had companies like both, Infinera and Apogee went through down rounds and they all ended up becoming really successful companies, right? So those are not really bad things, but getting the cash in the bank to keep the company going is more important than that. And then the last thing I would say is that, even in these downturns, you can't be only defense oriented. You kind of have to be offense oriented where, when there's a downturn, maybe your product strategy was all haphazard because, so many people were giving you money and, you were building all of these things which actually didn't make any sense. So focusing on the product strategy, focusing on how you're going to increase the cross-sell, upsell, how you're going to go into adjacent markets to increase your TAMs, and then kind of executing on that, right? You can do a lot of acqui-hires. You can do, get talent a lot better nowadays because of the downturn. So ultimately, all it gets back to is that if you have the cash, you can do all of this. And so having that cash is probably the number one thing you should do.
Got it. Where are you advising portfolio companies to be in terms of number of months for runway?
It depends on companies, right? So there are companies which are kind of struggling, growing at 15-20%. For them, I'm really saying that, hey, look, you've got to get to cash flow break even in these numbers because, at 15-20% growth, you're probably going to have a really hard time raising money. But if the companies are growing over, 50-60%, then I'm telling them, hey, grow, patiently, but have at least 24 months of runway because I think you probably can raise money again end of next year, more likely middle of 2024, right? Q1, Q2. I'm also advocating or advising companies to be much more efficient because if you look last year, everybody had so much capital that nobody paid attention to efficiency metrics, right? Every company I know is going through this process and saying, hey, we overhired and, we just hired the wrong type of employees that didn't really fit. It's not like the employees are not good or anything with them, but they're just not a fit with what we are trying to build or what we are trying to sell. And just getting rid of all of these people that people have overhired is going to make you much more efficient. So yeah, having people take a really, really hard look at their employees is one other areas where, I'm asking people to focus on.
You talked about advising companies on whether to play offense or, maybe bolster the war chest and add some capital. But are there any other factors that are going to set apart startups that will rise above and prevail during these times versus those that are going to fail?
Yeah, I think at the end of the day, startups are very much driven by their CEOs and the grit and determination of the CEOs, right? There'll be some times when people will say, hey, look, this is just not worth it. I'm just going to sell the company, and, there's a math to be made, right? If you own 10% of the company and, you get 300 million, 400 million for it, that's still a big chunk of capital for you. So there is going to be some people, I think, who will take that route and basically tell their company saying, hey, I get 25, 30 million out of this. I'm good. If they haven't raised too much money. I think the people who are going to be successful are the ones who have the grit and the determination, first and foremost, who kind of say, okay, you know what, I'm going to stay for the long run and go for the home run, and create a big company. And I think second, they have to have a great management team around them who can really take advantage of the downturn. Because during the downturn, being nimble and figuring out, okay, who is not doing well and which areas that we can get into quickly and, grab initiative, those are all the things that a great management team can be nimble and do. So if they have that and they have the grit and determination, I think those are going to be the ones who are going to come out of it, really strong in 2-3 years.
Yeah. I'm sure you have a much better pulse on this than I do from a macro perspective. I'm curious what the next 6 to 12 months looks like from your point of view.
I wish I knew because then, I would be probably playing the public stock market. I don't know when the macro trends are going to change. I can't forecast that. But I think our general thought is that from a multiples perspective, I don't think we are ever going to go back to these. I shouldn't say ever, but in the next 3-4 years, go back to the kind of revenue multiples we used to have in 21 and end of 2020, right? I think the revenue multiples are probably going back to, for great companies, probably 8 to 10 times forward revenue multiples, and then for people who are growing less than 35%. Probably go back to 3-4 times or 5 times maybe forward revenue multiples. And I think that is where it's going to stay. I don't think, and yeah, sure, if the interest rates go back to zero at some point, maybe they come back and we go up a little bit more in the 12-15%, 12-30-15x. But I think that is one thing that we are projecting and what we are basing our investment, saying that, when these companies exit, the really good ones are going to exit at 8 to 10 times forward multiple and kind of work backwards to see what we can pay. And then also how long it will take us to get, say, a 2.5 to 3x kind of return, right? But that is the only thing I can say with surety that's going to happen. I don't know that from the macro standpoint, it is really hard to predict because it's the ways that, it's still hard. Like look at the amount of the job reports and everything seems to be going well. But if you look in tech, I think the number of layoffs has been just going through the roof, right? Somebody had reported that November already had the highest number of layoffs, even more than April of 2020. And, it has, and we haven't seen the end of November yet. So I think in a small kind of in the tech universe, there's already a big kind of a recession or, slowdown going on. In the greater economy, it's hard to say what's going to happen, but in pockets, you see the slowdown in housing, the slowdown in different parts of the segment. And we are seeing that in our portfolio companies, right? There are a lot more companies that missed in the Q3 versus Q2. And I think there's going to be a lot more companies as a percentage wise in our portfolio that will probably miss Q4. And then everybody, just like the public companies, are going to reset their 2023 numbers.
Mm-hmm. Last question before moving on. What advice would you have for emerging managers fundraising during the next 6 to 12 months?
Yeah, I think you have to be patient. I think, one, you cannot give up hope because you're probably going to have kiss more frogs than you did before. But look, I think in venture, at the end of the day, tenacity always wins. And, it doesn't matter if you're a CEO or an emerging manager. And so being tenacious and kind of having the focus on keeping on going, and spending a lot of time fundraising. I think LPs in general, are kind of all inverted right now, right? They have too much allocated to venture. They're not getting enough capital back from the existing managers to kind of fund their commitments for next year. So you'll see a lot of LPs kind of, saying that we are not doing anything next year. But that's why you have to be patient and kind of see that your fundraise is probably going to take longer than what it was in the last few years.
Yeah. It also seems that LPs are prioritizing funds that have true DPI over TVPI. Have you noticed this as well? And I'd be curious to get your insight on that.
Yeah, no, absolutely. Because look, DPI is what now matters, right? In some ways that people have all made these commitments and fund managers had come back like every 12 months, right? Instead of even 18 months. So all of these fund managers, LPs have to commit to these funds that they have, when they ask for the capital call. So they are looking for DPIs. And I wouldn't be surprised if some of these LPs actually sell their stakes in the secondary market to get more liquid. Because, they have made commitments, so they're going to look at some of the managers that they're not going to commit in upcoming funding cycles. And they're probably going to try to, sell off their LP stakes in the secondary market. So I think there's going to be a lot of secondary sales of LP stakes going on next year.
Interesting. I'd like to talk about a different area that I would say is as topical as the macroeconomic environment, and that's crypto and Web3. So, crypto, Web3, blockchain, each is a fairly broad term, in my opinion. Overall, what areas have true enterprise value and what areas are overhyped and you're actively avoiding?
So, we were always looking at kind of the infrastructure for Web3 and blockchain, right? So we didn't actively invest in a lot of, the lending companies, right, which are all having problems right now. We were not smart enough to say that we knew it beforehand, but we also passed on investing in FTX because, we've never invested at such high valuations or, in a round which was not being led by a firm that we knew. So in general, we didn't invest in a lot of the lending kind of infrastructure like BlockFi, and things like that came by our desk. But I do think the whole blockchain and crypto and Web3 kind of play into each other, right? So first and foremost, the thing about blockchain is that you have these smart contracts. And one of the big things that has happened up till now in the protocol side, internet protocols are dumb. So it didn't really have any logic, and all the application and the logic was all hidden in the application code, right, above, and which was always opaque. That was never kind of transparent and for everybody to see. And that is what the fundamental thing that is different with blockchain is that the actual logic can be pushed down into the protocol as a smart contract where everybody can see and interoperate, right? Where you don't always need to have a trusted party for a business network to form because the application logic is out in the open. And I think those kind of business networks where you needed an intermediary, trusted intermediary, may it be financial, it can be like, pharmaceutical kind of consortium or anything. Over time, you will not need it because the application is there, right? So that's number one. On the infrastructure side, I think, this distributed kind of computing that Web3 is kind of advocating and putting out in front of us is actually something that hasn't been done before. Like if you look at Ethereum, right, that is a infrastructure that is open source. That is the proof of stake that happened was probably the largest open source event that has happened, right, that went off smoothly. And that allows you to build these applications which are distributed and secure and that, nobody really has control over it, right? It's like nobody kind of builds like AWS or a Google controls what that application is doing. And it's kind of distributed across all the validators and the node providers, right? So that is the other thing. And then the token stuff, it hasn't really worked yet. But if you look at it, there is a possibility of using tokens as a way to reward people who are building stuff for you, right? In open source up till now, when developers wrote code, they never got to monetize it unless they joined the company that was built around it. And somehow, that company went public and they got money out of that, right? Tokens enables you to reward people who are helping you build something. And over time, potentially also incentivize users to use that platform. Now, it has been just like anything else, like in the internet days, people misused, all the stuff that was going on. Similarly, tokens have been misused in the way that, people were given tokens that got traded. They sold out their tokens and moved on to the next protocol. But I think over time, you will see these tokens being used in a much more effective way to get developers to help you build the platform, monetize and reward the community, and over time also reward the users.
What do you think is going to prompt that? I mean, we just experienced the collapse of FTX and there's a call for regulation. In your opinion, what needs to happen for these technologies to reach their full potential?
So I definitely am in the side of having more regulations. I think I'll be called by a narc by all the crypto enthusiasts. But look, I think in some ways having regulations is actually a good thing, if it's done properly. And I know once the regulators come in, they'll probably flip over in a big way. And there's a pendulum that always swings where it'll go probably be more regulated than it should be. And over time, the right amount of regulation will take hold. But I do think that because of this debacle with FTX and 3AC and Luna, I think it has set back probably Web3. I don't know if a couple of years, hopefully not longer than that, because all the financial oriented services like the lending and kind of the hedging, those were the first use of tokens, right? And crypto, kind of the blockchains and and the usage of all the different protocols out there. So now finding the next use case, there's a lot of activity around gaming that is going on with the protocols. Maybe that will be the next kind of a way that application that is used that kind of causes the adoption of the protocols and Web3 and blockchain. But I think finding the next application, like, if you look back in the internet, the browser was the thing that really drove the adoption of the internet, right? Mm-hmm. And in crypto and blockchain, it was all the financial services oriented applications that was driving the adoption of the protocols. I think there has to be something else that pops up that really drives the adoption of Web3 and blockchain.
It's an interesting analog. Where do you think we're at in terms of seeing the collapse of some of these companies? I mean, like we mentioned FTX, obviously that's very top of mind for a number of people, but there's BlockFi, Terra. I mean, do you expect this to be a similar trend moving forward over the next 6 to 12 months? Or what do you foresee happening?
I do think that, there might be other companies that, go bankrupt, right? People are already talking about, Genesis and things like that on Twitter. I don't know. They do or they don't, but I do think that a lot of liquidity has gone away from the market. A lot of people on the institutional side who are trading crypto and, are probably going to be a lot more wary of, doing anything with crypto. And I think the retail investors are probably gone. A lot of retail investors are gone because, people will say crypto is kind of, I don't want to go there, and Bitcoin, everything will go away. So I do think over time, institutionals will come back into crypto trading, but that's going to be probably, another 18 months before there's liquidity and, there's enough lack of fear to go back and trade, all the tokens out there. Mm-hmm. But I do think what you'll see is that there's also going to be culling of the tokens, right, out of the protocols. Like, I think you will realize that Bitcoin, ETH, and, maybe one or two other protocols are the ones where everybody flocks to. And they'll come to a point where you won't have these dozens and dozens of protocols out there coming up every day trying to build an ecosystem around it. And everybody will just focus on 4 or 5, maybe 10 different protocols and build everything on top of it.
An area that you said you've been spending a lot of time in is Web3 infrastructure. What major needs have yet to be met by existing tooling?
Everything, right? So first and foremost, that there is no DevOps kind of tooling out there, because I was a developer in the early parts of the .com, and you had to write everything from scratch. Like, you had to write the backend server, you had to write the load balancers, you had to write everything, to the point where over time, nowadays, you can just write a few lines of JavaScript code and have everything working because AWS and GCP are all providing that. We are far away from that, right? Right now, if you want to program on ETH, you kind of have to know Solidity, right? So things and if you write a smart contract, you don't know how to audit it and make sure to test it and make sure that, you haven't done something stupid in the smart contract that creates all kinds of issues down the line. So the testing tools, DevOps tool that helps you build these codes really easily, integration tools where there's no communication between one chain to another, right? You have these bridges, but the bridges are, very kind of, I think, backward using way of doing things where you're actually holding value in the chains itself, in those bridges, rather than just communicating over the data between chains. So all of those things have to be built up before I think you can build a lot of applications and have thousands and thousands of applications being built. Because most developers, if you do they're not like want to learn everything from scratch. They don't want to learn Solidity. They don't want to learn, how does this smart contract work in this chain versus that chain. They want to have an easy interface that allows them to kind of abstract away all of these things and help them express what they need to do to get a program done, and everything is done underneath for them. And that is why this interest of ours to invest in this kind of infrastructure, because if you look back at the .com bubble and a lot of infrastructure companies came up and they all became big, and of course a lot of them got acquired by Cisco and became part of Google and Yahoo. But that's kind of where we think there's a lot of money and big companies to be built.
Yeah. Where does the value accrue in the Web3 developer stack, and how does that differ than Web 2?
That's a very interesting thing. I think in Web 3, the developer who builds the application can actually accrue a lot more value than, like in Web 2, right? All the value kind of accrued in the people who aggregated all this information, right? Mm-hmm. It aggregated in Facebook, it aggregated in Google, because they were the ones who were at the end of the day in front of the users, and they could aggregate all the usage that's coming through down to the who's getting paid, right? I think in Web 3 there won't be any chokeholds like you have in Google or a Facebook, where all the money kind of goes down through one funnel, or Apple, right? Those are the main chokeholds. You'll see a lot more distributed kind of companies where 3, 4, 5 developers might have a lot of ability to kind of monetize what they're doing. And there might be an aggregation point where somebody kind of aggregates a lot of these developers together and builds something on top of it. But I don't think there will be, like in the Web 2 world, 4 or 5 companies that is basically owning all of our internet, Web 2 kind of usage.
Mm-hmm. Mm-hmm. I want to shift gears a little bit to talk about your track record, because you've invested in 13 companies that have IPO'd. And you noted how difficult it is to predict from seed to A or even all the way up to Series C, which CEO and team can actually create a highly valued public company. But again, you've been able to do this 13 times. So if you're not looking at the team, I would be curious as to what you're looking for as far as indicators go that a company can be valued in the public market as a highly valuable one.
Yeah, so I think one of the things that we are a little bit lucky because we are all looking at, we look at a little bit later stage companies, right? And I think the number one thing that, people will talk about team and culture, but for us, it's also the efficiency. I think one of the companies, if you start out being a very efficient kind of a team that's growing really, really fast, you kind of that DNA kind of stays in the company and keeps going, even though the team might not be that impressive. Like, I'll talk about something that is not, my portfolio, but we looked at called Datadog, right? Datadog had incredibly efficient metrics when it went through and raised its round. But if you go back and look at, talk to a lot of the investors, they didn't have a very easy time raising funding. They actually went around quite a bit, because one, they were in an area where lots and lots of companies had been funded and were not successful. The team wasn't at that time like the stellar team with lots of, successes in the background that they had come with, right? But if you looked at the track record in there, how well they were executing and the efficiency, that was kind of, best of class that we've ever seen. And, they kind of learned, right? Also the fact that even after IPOing, that they have been able to kind of not only keep that machine going, but have been very nimble, right? That is one of the hallmarks of successful companies, is that they've figured out their first product. And then once they went IPO, very quickly figured out the second and third product and became a platform. Mm-hmm. So efficiency is one thing that you have to look at it. And then also you have to look at the product roadmap, in my mind, to see how quickly they can kind of, not only have one product, but can sell multiple products and upsell and cross-sell to the existing customer base, which allows them to have a really high NDR.
Yeah. I mean, it's always easier in theory than in reality to upsell and cross-sell customers. Rippling has done it incredibly well, right? And we can spare the audience behind why they've been able to do that so well. But if we think more from a foundational standpoint, what separates the teams that have been able to do this well versus the ones that haven't?
I think that the teams that have done well always have, I'm a developer, so I always bias towards it to some extent, but they have like a product-minded CEO or, a management team that has a product team along with the go-to-market team, right? And I think that is the number one criteria, because if you have a product-led CEO who understands product, is also good at go-to-market, they are always going to, in some ways, out-execute. Because at the end of the day, go-to-market wins, but ability to build a product that you can sell, cross-sell, upsell, and increase the size of the TAM is more critical than just the go-to-market, right? Because you can always find the go-to-market leader that you can bring in, but it's always sometimes hard to find that product-minded CEO that can really take the company to the next level.
How do you advise companies from going wide and expanding the existing product into adjacent markets versus going vertical within the existing market and layering on additional product features and functionality?
Yeah, so it all depends on who you're targeting, right? If you're a infrastructure company, you kind of have to in some ways say, okay, am I going to be just focused on the developers, or am I focused on the CIOs? I'm focused on the analysts, because infrastructure analytics or a kind of a horizontal software company, it's very hard to go from selling to the analyst to the to the CFO, right? So you kind of have to say, okay, from the analyst, do I go sell to somebody in the IT who might be also an analyst, or to the data scientist, who is adjacent? With vertical SaaS companies, right, I think there it is much more about, okay, I'm focused on a specific vertical. What are the things I can do within that vertical that helps the people within that organization, right? And a lot of time, those vertical SaaS companies, I think, have to monetize through payments, right? Like Shopify is a great example. Viva is another example where, they stayed in one vertical, but when, did more and more stuff for the same business. So you sell to the CFO first, the CMO first, then maybe the CPO within the same vertical. And this is more on the business application side, than on the infrastructure side, because I think on the infrastructure side, you really have to go horizontal to build a big company.
Yeah. Do you have a preference for one versus the other?
So I like infrastructure and I like analytics. So I like the horizontal plays. Also, I've done like payments like, Square. I've done, call center company called Five9. But I typically like the more, platform things like a MuleSoft, or a JFrog, which goes across industries, but sells to a specific set of folks in these industries.
Got it. Jay, if we could feature anyone on the show, who should we interview and what topic would you like to hear them speak about?
That's a hard question. I think you should probably feature some of the CEOs who are kind of going through, I would say people who are building the next generation of companies of consequence. I would say Sanjay Berry from Netscope. He would be one great person to kind of talk to. I would talk to Constantine from BlockDemon. So he's building the kind of the infrastructure for Web3 and, see what his thoughts are on Web3 if you're interested in that. And Sanjay, started Netscope, which is kind of trying to be the cloud security company and, his thoughts. Those two people I would definitely recommend.
Jay, what do you know that you need to get better at?
Well, I think one is time management. I think I spend too much time on Twitter, even though, things are going haywire. And I think, one of the things I think sometimes you always think about is getting better at saying no. Like, I know we spend a lot of time saying no in our profession, as no to CEOs, no to next round of funding. But even then, I think we sometimes, because of personal relationship, I sometimes have a hard time saying no to some CEOs or some founders that I've known for a while. And I always, even though I might not be investing, I try to invest my time in helping these founders. And sometimes, that becomes burdensome. But yeah, getting better at saying no.
And last question, Jay, what's the best way for listeners to connect with you?
They can just send me an email at jai@sapphireventures.com.
Awesome. Well, Jay, thanks again for coming on the show and enjoy Hawaii.
Okay. Thanks, Nate. Thanks for having me.
You bet.
All right, that'll wrap up today's interview. If you enjoyed the episode or a previous one, let the guest know about it. Share your thoughts on social or shoot them an email. Let them know what particularly resonated with you. I can't tell you how much I appreciate that some of the smartest folks in venture are willing to take the time and share their insights with us. If you feel the same, a compliment goes a long way. Okay, that's a wrap for today. Until next time, remember to over-prepare, choose carefully, and invest confidently. Thanks so much for listening.